Alrighty, hello and welcome to, I don't even know what episode we're on now, but welcome to The Upside with Eli. We're joined today again with Dylan Reber, portfolio manager, financial planning extraordinaire. This episode is always brought to you by Up Financial, I think they call it the world's greatest financial planning and wealth management firm.
I've heard maybe the Milky Way's greatest.
Probably
It's
that would make sense. Shout out to Up Financial. As always, we talk on this podcast, we answer your guys' questions, and we have a whole bunch that we've kind of categorized today. Markets have been down a little bit. Crypto markets especially have been down a whole heck of a lot. And so we're going to be asking Dylan a whole bunch of questions around taxes. So if you have any more that you want to have answered, please feel free to put them in the comments, and we will ask them on the next episode. So Dylan, welcome.
Thanks for having me again. Good to be back.
Yeah. Alrighty. We got 1, 2, 3, 4, 5, 6, 7 questions that we're going to answer today. First, number one, obviously when you have losses, one thing that we start to do, we look at utilizing those losses and how do we actually utilize them in the grand scheme of kind of managing taxation in terms of investment management. What is a tax loss sale?
Yeah. Basically, this is the simplest way to just kind of make the most of a bad situation, right? If you have an investment, not all investments are going to go up. Some are going to go down. So if you buy an investment and basically you have a capital loss, which if anyone's watching doesn't know, it's basically if you buy an investment for $100 and now it's worth $50, you have a $50 capital loss. So a tax loss sale is simply just selling the investment that is down, assuming you don't want to hold it anymore. You're basically just taking that loss and now you can use it on your taxes to offset other capital gains. Thereby reducing your taxation on all of your investments together. Yeah.
Cool. And in Canada, I guess, why would somebody want to, kind of utilize that loss, and what other assets might they have that they could utilize those losses against? Like what kind of assets qualify for capital losses or capital gains?
Yeah. So it's primarily, technically any kind of taxable investment asset, right? So it could be like rental properties. Normally we're looking at in the context of a stock or kind of investment portfolio, but anything that has capital gains, you can deduct capital losses against. So you can't use capital losses to offset, regular like employment income or stuff like that. It only works for capital gains. We'll get to some of the other strategies you can use. What if you don't have a capital gain right away to offset, right? What do you do then? But yeah, you can use capital losses to offset capital gains.
Cool. So question here is, what is tax loss crystallization? It sounds like a fancy term. What does it actually mean?
Yeah. So we're kind of trying to go in order through these, right? So, like I said, the first one, capital losses or tax losses is just selling an investment you don't want to hold anymore. And now you get a loss. Now, this is part of it. What happens if you don't have any gains to offset that loss right away? First things first, we talk about you can carry those losses back up to 3 years. And so you have to use them in the first year. Then you can carry them back up to 3 years prior or forward indefinitely in that order. Now, what if you don't have any losses from the prior 3 years either? You don't have any losses this year gains to offset. Now, what do? Crystallization is the idea of purposefully realizing other gains that in that same tax year that you can then use your capital losses to offset. Basically, what you're doing is we could say bumping up the adjusted cost basis of let's call it the winning investment. So basically now you get to realize a certain amount of those gains essentially tax-free because you get to use the capital loss to offset them. And that's crystallizing. We could say crystallizing the gain.
Yeah, absolutely. And so why would somebody want to do that?
Essentially, we're going to start to get into some of the nuances, I guess, quicker than I expected. But essentially, what you're doing is tax deferral. But depends. We'll get into that. But why would someone want to crystallize the gains? Again, so you have a gain to actually use the loss against, right? So you're not just realizing a capital loss, taking a loss on your investment without getting any tax benefit from it right up front. So again, if you don't have any other capital gains that you can use the loss for already, you're generating a capital gain so that now you can use that loss. You actually get a benefit from, like I said, making the best of a bad situation. And now basically when you bump up the adjusted cost basis of, again, the winning investment, the taxation on that investment moving forward is lower, right? Any future capital gains you have on that investment are going to be lower because you've effectively purchased it. That's kind of what your adjusted cost basis is. You've effectively purchased it for a higher price. So any future gains are going to be lower.
Yeah, makes sense. Cool. So what are the superficial loss rules? Because a lot of people talk about that. Explain what the superficial loss rules are.
Yeah, and so now we're starting to get into the simple case, right, that we just talked about is, regular tax losses and maybe some tax loss crystallization, basically just getting rid of an investment that you don't want to hold anymore, right? You made a bad stock pick, your mutual fund didn't perform, whatever it is, right? You don't want to have that investment anymore. That's the simple case. Much more, maybe not more common, but certainly like in my portfolios, most of the investments I have are ones that I want to hold for the long term, right? So that's the next question is, what do you do? How do you make use of tax losses on investments that you don't want to get rid of permanently? And the first thing we need to understand before we can start talking about strategies to do that is the superficial loss rules. Basically, like in the US, I think they call them the stop loss rules, kind of the same thing. Basically, the idea is disallowing the use of capital losses on investments that are just sold very temporarily. So basically, there is a period of 31 days before and after the sale of an investment. Or is it 30 days?
30 days.
I always get them mixed up. Yeah, I always do 31 days just to play it safe.
It's actually longer than 30 days. So technically it has to be, I think the way it is the 31st. So it's kind of right. If you're 31, you're going to be extra safe anyway.
That's because it's the day of the trade and then 30 days before and 30 days after, right?
Yeah.
So basically what that time frame is saying is if you purchase an investment up to 30 days before or sell it up to 30 days after, there's that essentially a 61-day time period where if you buy the investment back again after selling it, or if you in some way still hold that investment, the loss is going to get disallowed. So basically what happens...
And why is that? Why does CRA say that?
In my opinion, it's because they just want to get more money out of you for tax perspective, but I guess just to prevent temporary short-term trading, just to get a tax benefit without any actual material change to your investments and
you're clearly only doing that to get a tax benefit. You're not actually changing or making a material change in what you're investing in. So their argument is you probably shouldn't get a tax benefit from it. There's going to be different arguments on that, but the rules are the rules, and we just got to follow them.
Yeah, look, it's in the name, right? It's a superficial loss. You didn't take a real loss off that investment, so you shouldn't get a tax benefit from it. Agree to disagree, CRA.
Fair enough. So how do you transfer losses using superficial loss rules?
Yeah, so getting in, we'll explain the mechanics of how the superficial loss rules work. Basically, I'll just use it's always easiest to explain this stuff with an example. Let's imagine you purchased an investment for $100 and now it's worth $50, and that's when you sell it. And then, before that 30-day time period is up, that superficial loss period is up, you purchase the investment back. Let's say it fell to $50 per share and stayed there. So now you purchase the investment again for $50. So what happens is because you bought it back in the superficial loss period, the loss is disallowed. So what they do is they basically just they change your adjusted cost basis. They basically add back that loss to your new adjusted cost basis. So basically you bought the investment again for $50 per share. You had a $50 capital loss that they're not going to allow. So they add that back to your adjusted cost basis. That sounds really complicated. Effectively, what they're just doing is reversing the effects, treating it as though nothing happened in the first place.
Yeah.
So now moving forward, it's like if you did permanently sell the investment, right, now your adjusted cost basis is back to basically what it was before, the $100 per share, let's say. So if you went and sold the investment for $50 permanently, now you actually get to use that loss. If the investment recovers back to $100 and then you sell it, you're not going to pay gains. You're not going to have capital gains and have to pay tax on like the recovery back to what you originally purchased it for.
Sure.
Right? It's all just basically meant to reverse the effects to make it like nothing ever happened.
Yeah. Yeah, you're not really getting penalized, you're just not getting an advantage. Yeah. Whereas you look at scenarios where I always use the common example as a comparison when people like sell property, for example, to their kids, below its market value. That's a really common thing that people think that they can do. And then what happens is you'll actually get hit with double taxation, where they get the adjusted cost base, the lower amount, they get the adjusted cost basis higher, but they get on the actual taxation, it's based on the lower amounts. They're actually going to pay tax twice on it. That doesn't happen with superficial losses. They just don't accept the loss.
Yeah. Did you talk about that with Brandon in the last podcast?
I don't know if I did.
Yeah.
I'm sure we've talked about it many times before, but that's just a common one, right? That kind of comes up.
Yeah, I've heard it. Like it's fresh in my mind because I know I've talked about it or heard about it recently within our practice. But yeah. So then understanding the mechanics of how superficial loss rules work, now we can answer the question, okay, how do you transfer those? And this is really important because basically it's a great strategy. Either A, if you personally don't have any losses to use, in the prior 3 years or in the current year, and you don't have any other gains to realize to do crystallization with, or more importantly, it's usually used as an income splitting strategy, right? So basically you need to have a spouse to do this. And if you have a spouse, who, let's say, is in a higher tax bracket, makes sense. You would want to have the capital loss essentially transferred into their hands so they can use it on their taxes to offset, their capital gains tax, which they're going to pay tax at a higher rate, right? Because they're in a higher tax bracket. So that's the idea. Basically, income splitting. It's another way. It's one of the many, loopholes like we've talked about before on the income splitting strategy podcast. It's basically a way to do that. Should we get into the the mechanics of how to work?
Yeah, let's hear it.
To do it.
Yeah.
It can get complicated, right? Especially if you're already struggling with the superficial loss rules, which again, even I do this all the time and I still have to check myself and make sure I'm saying the right thing. But basically what you do, because you're related parties, you and your spouse, if you have an investment that has a loss, you sell that investment and then your spouse buys back that investment. Because you're related parties, the CRA is still going to disallow that loss, assuming it's all done within the superficial loss period, which is what you have to do to make this work. So basically, you sell the investment, your spouse buys it back the next day, same day, whatever it is.
Yep.
Basically, now that disallowed loss is going to get added to their adjusted cost basis. So let's say you bought it for $100, sold it for $50, and then your spouse bought it back that same day for $50. That superficial loss of $50 is going to get added back to their adjusted cost basis. Now their adjusted cost basis is $100, 50 plus 50. And now if they turn around and sell that investment, for good, they're going to sell it at $50. Their adjusted cost basis was $100. Now they have a $50 capital loss that they can use on their return rather than yours. Kind of stupid why you have to do this way. Why you can't just make an election on like a tax form or something like that. But that is how it's done. Really important to note. And this is kind of getting off track, but it's on the same topic of the mechanics of how this works. Same as most income splitting strategies. It's really hard to do this if you have a joint account.
Sure.
Because it's a lot harder to have that proper auditing trail if it came up.
Yeah.
And some investment firms outright just don't even allow you to transfer the tax ownership, between
it just
spouses.
It just gets really messy, right? People will do it because they want, right of survivorship, and there's a couple of advantages to it. But if you're doing any kind of more of those advanced, kind of tax strategies, it's definitely way cleaner to have just two separate joint accounts or two separate individual non-registered accounts.
Yeah, and I mean, in your opinion too, I know what I've seen. Even for myself, I find it a pain in the butt to just do the bookkeeping, even though we have it separated. Probably you're going to want to hire some type of bookkeeper to do it or take up a lot of your time to do it yourself and make sure you're doing it properly. What do you see people doing?
Yeah, I mean, we'll work with different accountants that have different preferences. So first and foremost, we'll go to the accountant and we'll say, how do you want this structured? Because we don't want to make more work for the accountant. Some accountants are fine with it one way and some accountants are really not okay with it that way. So that's usually our starting point. And then there's usually a number of factors at play there, right? We've kind of done, I'd say, all the different variations of it per person. There's not one perfect way because all of them require a little bit of, minutia in terms of, kind of structure. So I would say, yeah, we can kind of show you a couple different structures and then we'll run it by the accountant to figure out how they want it structured, how they typically deal with it in their practice.
Yeah, and based on what the accountant wants to see, how they want it done, what the setup is. One thing to be mindful of is, are the tax savings going to outweigh any additional costs, especially accounting and bookkeeping costs to do that? So just always
we're typically, I mean, when we're talking about these strategies, these are typically multi-million-dollar non-registered, portfolios. these aren't on, obviously on registered assets, and they're typically not on. It's not worth the time and the effort and the headache to do this for like small sums of money.
Yeah, that's a big thing to keep in mind.
Yep. Yeah. Cool. So one of the questions here, it says, how to substitute investments, how to substitute investments and what counts. So we kind of talked about what we think this person's trying to ask.
Yeah. So like basically,
so I think it comes back. What do you do if you still want to hold the asset, but you want to take advantage of superficial loss? Or sorry, you want to be able to take advantage without getting hit by superficial loss rules.
Yeah, exactly. And I think that sounds like that's what they're asking. So basically, continuing along that track of, okay, we're beyond just the simple case where you just have an investment, you don't want anymore, sell it for a loss and use it. Now we're at the point of you have an investment it's still a good quality investment. You still expect it to go up over the long term. It's just down temporarily from where you bought it. How do you make use of that loss? So again, you can always just wait the 30 days to buy it back. That's the simple solution. Now, one thing, and depending on who you ask, if you ask myself, I think you as well about timing markets, it's impossible. So the question becomes, what if you don't want to be out of the markets for 30 days? I mean, what if that's when the recovery happens, right? Or even some of the recovery. So you don't necessarily want to be, 30 days isn't a short time to be out of an investment. So one thing you can do is have basically a substitute. Like substitute a different investment, not to be confused with substituted property, which is, we'll talk about them hand in hand. Basically, the idea is, let's say top of mind right now, like you said, cryptocurrency or like precious metals, right? Which are taking big hits right now. Let's say you have a crypto fund or crypto or whatever type of crypto investment you have, and it's down a lot right now. You want to make use of that investment, but you want to hold the fund or whatever over the long term.
Yeah, you still want exposure to effectively the underlying asset or a very similar one.
Yeah. So the idea is exactly that. Find a similar asset. It has to be different enough that it's not considered basically identical property. In terms of it has to be substantially different. So basically, I'm going to use fund, right? So we don't get into mentioning any specific names and get into issues with the regulations about talking about investments. But let's say you've got a crypto fund and then there's another crypto fund and they both have similar investments in them. They're probably going to have things like Bitcoin and Ethereum and, the main ones. But let's imagine, they're different percentages. They're managed differently, right? They're different funds. That would be an example of a substitute investment that you could purchase, right? You still get basically the same exposure, right? So that if cryptocurrencies start recovering during that 30-day period, you get to still partake in that growth, but you also get to make use of the loss, like you're not going to get hit with superficial loss rules. And then basically you hold that substitute investment for the 30, 31, I always do 31 days, but hold it for that month basically, and then sell it at the end, purchase back the original fund, assuming that's still the one you want to be in.
Sure.
And that's basically how to do it. And the big thing is the other part of this is just making sure that it's not that it's a substantially different property. Because if you, for example, there's been a lot of debate and there's no perfectly clear guidance from this area is what constitutes substitute property or not. For example, there's been debates of, does a corporate class mutual fund, is that substantially materially different from a mutual fund set up as a trust, even if it's the exact same fund doing the same things?
Yep.
Because they're different structures. You can certainly make the argument that they're not the same thing. Same thing, like a lot of mutual funds these days are starting to offer like ETF versions that are traded live on the exchange. I mean, that's a material difference. Is it enough? That's the question. My experience, best practice is just to get a different fund, right? If you have like
there's enough of them out there, like why not?
Yeah, right. Yeah. The whole point is for the 30 days, get close enough that you're still partaking in at least most of the returns, potential returns.
Yep.
And just make sure you're not getting hit by superficial loss rules.
Totally. Yeah. No, that makes perfect sense.
Feel free to add anything if you want.
Yeah. No. I think at the end of the day, a lot of the times we talk about, we want to talk about some scenarios where it makes sense. And for a lot of people right now that might have losses on the books, we did a lot of this planning kind of 2023, 2024, where people had losses that they may have, for example, we did this in 2022. So when equity markets were down, and the bond markets were also down, people had a lot of losses, right, on the books. But they had a lot of gains, 1 year prior, 2 year prior, 3 year prior. There's tons of gains on the books. So you can trigger those losses, while they're down, and then use them to offset the gains from previous years because you can carry them back up to 3 years. And then moving forward, obviously, if you have losses right now, like say your Bitcoin is down, or some of your precious metals holdings are down because you just you bought it at a peak or whatever, you can trigger that knowing that, okay, maybe I need some income right now. So what I'm going to do is I'm going to trigger some of those losses so I can sell some other securities that I wanted to trim some positions on anyways, right? To kind of utilize that. So you're not actually paying the tax, right? There's still going to be tax owing, assuming those asset classes recover over the long run. But it's manipulating it so you're deferring a lot of that taxation over the long run, and that's where you generate a lot. You don't really see those returns on the books, but they're all hidden behind the scenes because at the end of the day, it's not just your rate of return, it's your rate of return net after tax. And so I think that's where a lot of that additional value comes from, especially when you have short or medium term goals and you'd access maybe some of the capital. These are all great methods to be able to kind of play within that system.
That's a great point, right? It's hard to quantify. Like when people ask, why should you work with a planner or an investment manager, some type of professional? The question always gets asked, because it's always gets brought down to investment returns. And let's imagine, not to say that this is the case, hint, hint, wink, wink, but let's imagine you are underperforming markets or just matching them, right? So in terms of investment performance on its own, you'd be roughly the same as if you just had like an index tracking the S&P 5 or something, right? It's hard to quantify, but it is a very real benefit, saving tax. And I always tell people that's probably, if it's not more important than the investment returns, it's very close second, is how much tax you save if you have someone managing the full spectrum, not just the investments. Because if you save, even a couple grand or a couple tens of thousands or hundreds of thousands, or however much tax, every year over your life, it's a lot of extra money to accomplish your goals.
Absolutely.
Not to get too off topic, but it is.
No, I mean, you're 100% right. Cool. Last question here. It's not really a question, but it's about tax loss purification. You're writing a paper on this right now. It's not published yet, but tell us about tax loss purification.
Yes. So basically, forgive me if this is a longer answer. I'll save most of the detail and the length and discussion and the whatever for the actual paper. But basically, tax law. Let's assume these two things are true. So this is sort of the base case, and these things have to be true. Otherwise, just use one of the more simple options. But assuming you have an investment that you expect to do well over the long term and you'd like to hold it. So we're talking about now dealing with superficial losses and all that kind of stuff. So basically, you want to purchase that investment back over the long term. And then the other assumption that we need to make is that, which is historically, this tends to be true when you look at the data, stock returns, investment returns in general tend to revert to their averages, right? So for this scenario, we're saying if an investment is up, has it had a really strong year, we expect that to maybe not necessarily crash the next year, but we expect the returns to be lower moving forward, and vice versa with an investment that's showing a loss. Again, assuming these are good quality investments, which is assumption one. So if it's showing a loss, we expect it to have basically the most room to have excess growth or return moving forward. And again, just to do a very quick, proof for that for people, that is true of the data, right? For most investments, especially like a diversified portfolio where you've got a lot of investments. What I say to my students, this is kind of the jokey way of saying it, but it's true. The average is the average because it's the average, right? It's kind of funny, but like if an investment had a really low return and never recovered, well, all of a sudden, if it never recovered to its average return, it's not the average anymore, right? And so, not all averages are created equal. That's why we tend to look at like long-term averages, right?
Yep.
But anyways, setting those assumptions, you want to hold the investment over the long term, and you expect things to go back to average, whether it's up or down, back to the average. Under normal circumstances, if you just kind of use like a tax loss crystallization strategy and use like a substitute investment, so basically you sell an investment for a loss, wait the 30 days, buy it back, essentially all you're doing is deferring tax. But you're not achieving any net tax savings, because what's happening, imagine like that investment you bought for $100, now it's worth $50, and that's when you sell it. You claim that loss, and you get to use it on your taxes, and then you buy the investment back, let's assume for $50. On the recovery from $50 back to where it was when you first bought it, just the recovery of the price, you're going to be taxed on that now. Right. And so that's where you're not achieving net tax savings. You're just deferring that tax.
Yep.
You're using some losses up front to shelter other gains, and then you're going to pay tax on additional gains on the recovery down the road whenever you sell that investment.
Yep.
And so the idea with tax loss purification, and this is why I picked the word purification for it, is to purify the recovery of that investment from any additional capital gains taxes. So basically the strategy goes like this. Let's imagine you've got two investments, A and B, that you hold them 50-50 in each of your non-registered, your taxable investment account, and inside your TFSA. I'll explain it. I can explain it later, or maybe I'll just explain it in the paper for people who actually really care. Doesn't really work with RSPs. It works with TFSA though. So imagine you have 50-50, 50 shares of each in your non-registered account and 50 shares of each in your TFSA. And A, we'll call investment A the winner, investment B the loser, right? So the loser is down right now, showing a capital loss. The winner is up right now, showing a capital gain. So the strategy goes inside the non-registered account, basically just a regular kind of tax loss crystallization strategy. Sell all of investment B, realize the full extent of your capital losses, use those capital losses that year by crystallizing some or all of the gains on investment A, the winner. And so that's what's happening in the non-registered account, just a regular, what we've already talked about so far. Now, in the TFSA, you take opposite transactions. So basically what you do is you now sell however much of investment A you need to buy back the full number of shares, let's say, of investment B as you had before. And so what ends up happening now is you've realized and been able to use a loss on your taxable investments, creating tax savings for that year. And now, inside the TFSA, that's where the losing investment is, which, again, with the assumptions in mind, this is the investment that's most likely to grow moving forward and have excess returns. Again, just the recovery back to where it was alone. What's happened is we've done the tax loss, just regular crystallization inside the non-registered account, generated a tax loss that we can use that year. Again, some capital gains, bumped up the adjusted cost basis of investment A, the winner, inside the non-reg account, and all of that good stuff. And now, inside the TFSA, we hold all of the investment that's currently down, the loser, investment B, which stands just on the recovery alone, right? That's going to be a gain that is now sheltered from tax because it's inside the TFSA.
Yep.
So effectively, it's almost like osmosis, right? If you think of it, we're moving the investment with the least chance of further additional high returns into the taxable account,
yep,
so that the taxation on that moving forward is lower. And we move the investment with the most potential for high growth and taxation moving forward into the TFSA, where it's completely tax sheltered.
Yep, makes sense.
So the end result is you still own the same amount of each of A and B in this case. You've never, one thing too is we haven't made any withdrawals or contributions or transfers between accounts. Money hasn't flowed out of one account into the other. We've only just done one set of transactions in the non-registered account, and then exactly opposite transactions in the TFSA.
Totally.
And so that's basically how this is where purification comes from. We're purifying the recovery, the gains on recovery from investment B from any future tax. And now we haven't just deferred tax using capital losses. We've actually achieved net tax savings. And that's the idea with purification.
I love it. It makes perfect sense to me. I'm excited to see the paper on it.
Do you want to ask why you can't do it in RSP?
I know why you can't do it in RSP. Why don't you tell everyone why you can't do it in RSP?
I'm sure you please. I want to hear.
Why you can't do it in RSP?
Yeah, why doesn't it make sense to do it in RSP?
Well, because when you pull that money out of the RSP, you're going to pay even more tax on it.
Yeah, right.
I mean, the nice thing is with the TFSA now is we're finally getting to numbers that you can utilize these things in a material way. Yeah. Historically, it hasn't really made much sense, but it would still be slightly efficient, I think, in an RSP, depending on the growth and tax rates and all that kind of stuff. But it's way more efficient in a TFSA. Now, with the amount of work that it would take to kind of restructure, it may or may not make sense given a particular, kind of person's situation. But your paper will tell us all about at what point does it make sense and not make sense. Yeah. And I think strategies like that are going to make more and more sense as the total TFSA room continues to grow and grow and grow. Like it's not, we have lots of clients that have, $250,000 or more, in their TFSAs, right? That's not an unrealistic number. Just even with, like balanced, rates of return having maxed out that account, since 2009, right? It's not crazy. Like we've seen obviously a lot larger accounts, but like we're starting to see averages, and kind of like that, 200,000 range.
Yeah, totally. And I mean, that's the interesting part. That's what I'm trying to work on right now is actually figure out that break-even point of when does it make sense to do this in an RSP? Because the basic explanation, right, is like you said, you're effectively converting what would have been a capital gain into taxable regular income.
Yeah.
Right. So that's why it's not really efficient. But to your point, there is still the advantage of tax deferral and investment. Like capital gains aren't a thing inside an RSP. So there's that advantage, and you got to try to figure out that break-even point. But it's very clear that obviously with a TFSA, it provides some pretty substantial tax benefits.
Absolutely.
One last thing I'll say about this, just for mechanics of the strategy. Well, obviously, there's a lot going on. It's pretty complicated. One thing to keep in mind is superficial loss rules still apply inside a TFSA. So you still have to you can't just sell investment B in the non-reg, buy it right back in the TFSA. You still have to wait that 30-day period or use the substitute investment for 30 days before you can buy it back in the TFSA.
Makes perfect sense. Awesome. Yeah. I'm really looking forward to seeing your paper on that.
Me too. I'm really looking forward to writing it if we ever get time.
Perfect. Well, thanks again, Dylan. Thanks for answering all those questions. Appreciate you coming in and kind of sharing your time. If you have any other questions for Dylan or for myself, we're going to be recording again in 2 weeks?
Hope so.
Hope so. Perfect. Well, thank you again and have a great day.
Cheers.